Well, hello and welcome to the Lending Podcast. We are here in Austin, Texas with JB, the Guru of Mortgage. My name is Jeff Jones, and we are excited to give some market updates for what we're seeing going on. It is the beginning of August, and give us a quick insight, JB, about what we're talking about.
Well, here we are, the end of summer, potentially, for those that are starting school in a couple weeks. And this should be a wind down of some sorts for the real estate industry. Usually in past years, the end of summer brings a slowdown. We're seeing things heating up,
Yeah.
and that's because interest rates are going down quietly. I gave this analogy the other day. It's like sort of a ramp at the restaurant, the wheelchair accessible ramp, very gradual decline. It's not a stair step down. We haven't had help from the Fed yet. However, we've had an incredible surge in bond prices over the last couple of months, and that makes yields go down, and that's what drives interest rates. And as those rates come down, we are seeing buyer activity heat up quite a bit.
Yep.
And the opportunity for refinances, which we're going to touch on.
Opportunity for refinance. So that is what is important for our message today, is that opportunity is now, and it's going to continue to be probably for the rest of the year. So what that means for buyers out there today is this could be a great opportunity for you to buy, because as rates are continuing to better improve for you, your affordability goes up. What it means for realtors is it allows your buyers to have more buying power, possibly, than maybe what they were pre-approved for a month or two ago if they've been waiting. And so there's some good information out there of like buying power just getting better, monthly people's basically more money in their pocket every month. So that's going to help out if inflation continues. So there's some good stuff we're going to go over today.
Yeah, let's touch on what that drop in interest rates really means from a monthly payment perspective, because that's really where everyone's focused on monthly payment. And we talk about this a lot, but with just general goods and services costing more these days, housing is so critical. Rents have been elevated in many areas, and so therefore mortgage payments have been elevated over the last couple of years because of the higher interest rates. So what does it mean when the interest rates drop a 0.5% or 1%? So let's do for instance, on a $400,000 loan, and interest rates, let's say a month ago, were a point higher than they are right now, which is about what the delta has been. It's been a huge drop, quietly a huge drop. It really hasn't made front page news. And again, the Fed is what most of the headlines focus on. We're not tied to the Fed directly. They do help, and they're related, but we're tied to the bond market. So when we see the bond market drop, the yields drop like they have, the 10-year Treasury as an example, that's dropped from about 4.4% to 3.9% over just the last month on the 10-year Treasury.
Yeah.
That's an indicator that runs concurrently with the bond market in many cases. Again, we're not tied to the 10-year, but it's a good indicator. And so with a 1% interest rate differential in mortgage rate on a $400,000 loan, that equates to about $4,000 a year in interest, right? 1% of 400,000, and divide that by 12. That's how much the monthly payment drops.
Right.
In just the last month, a $400,000 loan was $333 a month higher a month ago than it is today. That's a car payment for a lot of folks.
Right.
So that's a huge drop. There's certainly lower interest rates available with buy downs. We talk about permanent buy downs and temporary buy downs. There's lots of tools out there. But overall, the takeaway here is rates have improved significantly, and it just has not hit mainstream yet.
Yeah, and we do this podcast because we want to kind of counter some of the information that isn't complete out there for you. Because as a lender, we are loan specialists. We're looking at market updates all the time. We're looking at actual pricing sheets every day. What you're getting from most media, they're not looking at pricing sheets of actual banks that are out there doing lending. They're just looking at forecast models. So even just the forecasts we've been seeing aren't like, we're actually beating the forecast models right now.
Yes.
So if, I got a little cheat sheet in front of me just to kind of cite some names.
Sure.
Because I think it's relevant. So this is August 2nd, forecast, just to date this, and hopefully we release this maybe this week. But Fannie Mae is going to say by the end of the year, average is going to be 6.7. NAR, National Association of Realtors, they got a lot of good forecasters, by the way. I'm a fan of that. 6.5 to 6.7 by end of year. So it's going to dip until then. 6.9 in Q3 is what they're saying. Mortgage Bankers Association, the MBA, they're a pretty big dog, 6.6 by the end of the year, 6.8 in Q3. And then you got, the Palisades Group, where they're a big forecaster. They're probably the closest to what I've seen, 6.25 by end of year. But what's funny is we're seeing those rates today, guys.
We're already there.
We're
We are
already
already. In fact,
there.
this
We're beating
morning
forecast.
we locked an FHA purchase, one of my first time home buyers, at 6.1, and they're not paying extra to get that interest rate. This is not where you have to come up with thousands of dollars to buy down these rates. These rates
Right.
are already available in many cases. Depends on the program, depends on the credit score, all those different criteria. But these end of the year forecast models, we're already there. And so that's where I think reading something like this as a buyer out there, you may say, okay, well, the end of the year might be a good time for me to buy. When in reality, by the time we get to the end of the year, we may be even lower than this. More buyers will have entered the market, and now you have more competition. And
Yeah.
so, for our agent partners out there, really being in tune with your lenders on what the trends are, what is going on today, not what went on last week or what we think is going to happen in 3 months from now. What's really happening on a daily, weekly basis, because this is changing and it's changing quickly. Now, let's talk about why that's happening.
Yeah, and the why,
Yeah,
yeah, that's good. So, I used to do forecasting models in my previous life. I worked for a Geico insurance company, and I was a forecaster. So we would forecast call volumes, we'd forecast just basically like hiring modules to make sure we had enough people on the phone. So what we're doing is by half hour, what's our volumes going to be? And we would do that over a 3 to 6 month period, every day. So we're going kind of longer term and short term. What's hard with forecast models, like even just the ones I've read, what they're doing is they're putting assumptions together, they're putting history together, they're putting direction together. And what that means is they get these complex models that have so many influential factors. Every data point will have a weight to it of how important it is and how much it's going to affect the movement. And every weight has assumptions of why are you assuming that the CPI index is going to move it this much, or that the jobs report is going to move it this much, because the big dogs are jobs numbers, if they're going up or down, unemployment, if it's going up and down, CPI index, consumer price index, if that's going up or down, and then the PCE index, which is personal consumption expenditures, basically the cost of goods, how much things cost. That goes up or down. Those are the big ones, and then there's thousands of other ones in there. What's going on with foreign affairs, what's going on with foreign investors, what's going on in our country, what's going on with all these other market indexes that we have for our economy. And it's a lot. So every day, these forecast models that I spouted out will change. Because as one of those influences change that number, it changes the forecast. So a forecast today will be different than the forecast tomorrow. There is something interesting in the media because the media is mainly what you see. Most of them like a doom or gloom clickbait scenario, or most of them like, let's sell some hope for a little bit and see if that gets some interest for people too. They're really going for what's interested to people because they want to make interesting content. It's not exactly factual. What we're here to do is give you good information for you to make good decisions. So I'm excited about this market update.
Oh, it's incredible because here we are at the beginning of August, sort of the end of summer, and we're middle of Q3, heading into Q4 here in a couple months, and we are at the lowest levels in mortgage interest rates that we have seen this entire year. So from January 1 to now, right now, this day, August 2nd, 2024, is the lowest mortgage rates have been for the year. And that's really exciting because there are a lot of folks that have been waiting and waiting for various reasons. Your lease isn't up yet, or you have a life event that you're waiting on happening, or you need to move in January, or you need, like, we're not necessarily talking to folks on a daily basis that are moving in the next 30 days. Right. So much of what we do is planning for 6 months, 12 months down the line. And we love to have those conversations because you can't be too early having that conversation to plan for your next housing move. I really truly believe that. You've got to be thinking ahead. Right. Otherwise, you can be on your heels and be forced to make a quick decision. Sometimes those quick decisions are not the best decisions. And you can overthink, but you can also be too hasty sometimes.
Yeah.
So,
and not only with that, when you start talking with a mortgage lender, you trust our last episode, if you want to cite it, episode 29 on shopping your lender. It's a great listen, but basically when you have a lender you trust, you can actually roadmap out your best scenario.
That's right.
And not only is it timeline of what you're going for, but also setting you up for the best program and pricing. So if you need credit improvement, if you need to move some assets around, if you need to do any other kind of work on your end to prepare for closing, you can do that before you go under contract. And a lender can roadmap that for you.
Yes. And these market indicators that we're seeing, I think it's part of a bigger picture right now.
Mm-hmm.
There are some macroeconomic issues that we're seeing. I mean, we're seeing unemployment is at 4.3% as of this morning. That is higher than pre-pandemic levels. We were at 3.5% unemployment in February of 2020. Then, of course, COVID hit and it really spiked. And then it took a while to come down. It was the end of 2021 before we saw unemployment under 4%. And then from 2021 to now, it's really been 3.4, 3.6, 3.5. And it's just kind of toggled back and forth, these moving these 0.1s. Well, this is 3 months in a row that we've gone up 1 or 2 ticks in unemployment. And now we're at 4.3, the highest level that we've had since, in 2, almost 3 years. And so as the unemployment rate increases, and we know the cost of money has been, to some degree, a burden on a lot of folks out there, commercial space, residential space. You've got elevated interest rates, and we've had them for several years now. And so that, what the Fed's doing to curb inflation, all of that was to make the cost of borrowing money more expensive, to slow spending, to curb inflation. I think we've really made some good progress on inflation. I mean, those numbers actually look pretty good.
So the demand has gone way down.
Yeah.
Right? The demand meaning people wanting to buy a home right now. That has gone so far down.
It has.
That it's helped cool inflation.
Yep. And I love what Warren Buffett says. When people are selling, I'm buying. And when people are buying, I'm selling. And so what are people doing? They're not buying as much right now. That means it's a great buying opportunity. For Warren Buffett, you're buying right now. Right? Because real estate in some pockets of the United States is on sale, and sellers are willing to make some concessions and some sacrifices. So it's a really good opportunity, especially if it's a longer term purchase. If you know you're going to be in the house for a few years, it's really a good time. And the cost of borrowing money now has really come down. October of 2022, October of 2023, not even a year ago, we were closing loans at 8%. And that's Mr. and Mrs. Perfect Credit was 7.998%. Now we're at 6 roughly. Again, a lot of factors involved there, but that's attainable for the typical buyer out there. It doesn't even have to be perfect credit. That's 2% lower. I mean, that cost of borrowing money, especially on a big loan, if you're $1 million buyer out there, your payment just went down almost $2,000 a month year over year. Mm-hmm. That's a big number. Right?
I want to be $1 million.
Right? Buyer. You can be $1 million buyer.
I could be.
Yes.
Could be. So all that to say, we're sitting August of 2024. Things are looking very good for not only our borrowers that are buying, but also just the volume ticking up. So as things become more affordable, as inventory continues to remain elevated, you're getting the pick of the litter of what you want to buy. So buyers are getting a lot more picky, we're noticing.
Yes.
Which is a good thing. You can really kind of get that home that you're hoping for instead of having a bidding war go on. And so we're seeing that. We're seeing realtors getting a lot more busy because people are now becoming interested. Those people on the sidelines are now showing up. And they're like, okay, maybe now is a good time. We're here to tell you now is a great time. It's the best time in a year, and it might start getting better according to every forecast we've seen. We can't promise that. No one can promise that because we don't know what might happen.
Yeah, but bold
but we're going
here.
In the right direction.
Yeah,
to get even more affordable rates.
We're going in the right direction, and that's without the Fed helping us.
And
that's
it might even help.
Fed. And I think next month, I do believe in September, bold prediction. I believe the Fed will cut, and I believe the Fed will cut the interest rates because they've been saying they're data dependent. If they're looking at the data, highest unemployment level in 2.5 years, really highest unemployment level since they started raising rates, right? Because they didn't start raising until 2022, and unemployment was basically 4% at the end of 2021. So here we are with data now. That's one piece of the puzzle, unemployment rate, but that some data that really supports what they've been saying. We're going to wait till we have the data. Now, I personally believe they're late. I think they should have already cut. And I believe they should have already cut because primarily the commercial space, there's a lot of commercial loans out there that need to be refinanced. And that prime rate right now is 8.5. So if you think about you're a home buyer out there, you're a real estate agent out there working with buyers, you can get roughly 6% money. Again, a little less, a little more, but let's just say it's 6% money. And the prime rate is 8.5. So your commercial spaces, right? Your retail, your doctor or dentist who's buying an office condo to move their business, they're borrowing money at 8 or 9%,
Yeah.
and you're buying a house at 6%, right?
Right.
So there's really a lot of indicators. Personally, believe the Fed should have already cut, but they've been saying they're data dependent, and it would have hurt Jerome Powell's credibility to cut prior to having the data. I believe the data came out in July to support that. I think they'll be cutting in September. They should be. I mean, maybe it's going to be December, but that's my bold prediction.
Yeah.
And when we have that headline of the Fed cutting rates, then we are going to see the natural influx of interest of people getting excited again, even though you're ahead of the curve by listening to this right now because rates have already come down.
Yeah. And there is different perspectives on, the September anticipation. I believe, there is a pretty good argument to be had that they might not cut rates in the sense that, you're saying you're hoping they do, you see that they do. There's other people that are saying they probably won't. And the reason there's differences is because as inflation starts coming down, that wind from underneath of it, as if you're landing a plane, the compression gets harder and harder to get that CPI index in line. And so because people want to spend, there's anticipation of spending. And so as spending increases, inflation goes up. But as we get closer and closer, if you start cutting too fast, then it makes affordability a lot more easier and people start spending a lot more than they would have anticipated in their forecast models. So all that to say is some people might think that they might not, because if you cut too early, then it just prolongs inflation. So that's the other side of that argument. But I think, if you're listening to this and we're just talking up things that you've never heard of before, and you're like, why do interest rates matter? I encourage you to listen to our episode 17 on, really, it's called Interest Rates Explained, and they go into how the federal government influences our mortgage rates and also what other things influence our mortgage rates. And that's a great episode for people that are wondering why this all matters. So episode 17 is great.
We really go behind the curtain a little more in that episode and really look at all the different factors.
But I think for our market update today, we're really hoping people see that now's one of the best times we've seen in over a year. What that means for buyers is this could be the best time that you've been waiting for now. You don't have to wait any longer. If you are going to wait a few more months, it might not be worth it because you might be into a lot more demand and you might be in bidding wars, but it still might be good. And for realtors out there, work with a good lender that's going to show people why now is a good time. Make sure pricing is accurate. If you've had pre-approved borrowers, if you are a pre-approved borrower, get an update of what your buying power is.
Yes, because that's a great point.
Yeah.
When rates come down a percentage point like they have, and your mortgage payment's now going to be $300 less, you can buy more home now.
Right.
You can stretch if you need to stretch, and that's probably the equivalent of $40,000 or $50,000 in sales price. So where you might have been a $400,000 buyer at 7%, you're a $450,000 buyer at 6% now.
Right.
Roughly. And so there's some different variables there, but that's kind of the equation. It really does improve your buying power. Thanks for touching on that.
Yeah. No. So, I mean, we're here for people. That's what we do. We love people to give comments so we can create episodes that people want. And do you have anything final to say?
Well, we've had a lot of refinance conversations. We touched on that.
Ooh.
And I think when you look back to 2023 and the buyers that were in position to purchase, and the rates just were what they were, right? I mean, I got 7.99 because that was what the rate was when I was under contract. It's the best rate I could get. And now those rates are 6.5 or 6. That is really a good delta to look at refinancing. Yes, they could go lower, of course, but you can always refinance again.
Mm,
And we might be bouncing off the bottom and we might be going back up soon. It depends on the data, right? If the inflation gets a little hotter, then for whatever reason, things that you just talked about, people's consumer spending, then that inflation number may tick up. If that happens, then the bond market could suffer and mortgage rates could go back up,
right.
irrespective of what the Fed does. So, as a refinance opportunity out there, look at your current loan, talk to your current lender. If you don't have a relationship, we're happy to have that conversation, of course, and do some math equations on what it would cost you to refinance and how much you'll save. And then we do that break even analysis, and you'd be surprised. Sometimes it really makes sense, and sometimes, and we'll tell you, stay put. You're in a good loan for now. We'll let you know when a better opportunity arises.
Good. I like this episode. So hopefully you liked it too out there. And, we are beating forecast models right now. Affordability is at the best it's been in over a year.
Yes,
Inventory is higher than usual because things have been sitting longer. This is a great time
it
to
is.
really buy a home or refinance a loan that maybe you got a year ago. So we're here for you. Please like, subscribe, and share to the Lending Podcast. And thank you so much for listening.
Thanks so much. See you next time.
Bye.